The biggest learning is our process really works.
Ciao. Last year we launched the Monroe Global Growth Small and Mid-Cap Strategy. It's now been running for 12 months. What have been your biggest learnings over that period?
Yes, we're definitely grateful that the Monroe Global Growth SMID Fund, as we call it, is coming up to 1 year. I think the biggest learning for me, I mean, it sounds like a cliche, but the biggest learning is our process really works. And it's really working in 3 ways when it comes to picking stock in the small mid-cap space. I mean, the first thing is really, our process is focused on earnings growth. In the past 12 months, we really resisted the temptation of picking up some stocks just because it is looking very, very cheap in the small mid-cap space. We have plenty of those candidates. And we also resisted the temptation to pick up, some of the high-flying story stocks where our math on earnings growth just cannot justify the valuation. And a lot of those stories didn't really end well either. And we just follow our process of looking for sustainable, longer-term earnings growth. And that really turned out to be the right approach at backing, not just 20 to 30 really high conviction stories and stocks, but really to be able to hold those stocks throughout a lot of volatile times. And I think that conviction and that root in earnings growth really keep the conviction firm. I think the second part of the process that really worked well was the risk management process. So when we launched the fund, we said we will have the exact same a stop loss trigger of 20%. As all the other Monroe funds. And we had a lot of questions from investors in saying, but the small mid-cap stocks tend to be more volatile, so maybe you should give yourself more room. Maybe that shouldn't be 20%, maybe that should be 30%. And now that we've been running the fund for a year, we stuck to that 20%. For the simple reason that this is a fund run by the exact same investment team, exact same process. So we just think organically and naturally that 20% makes sense. And we've had lots of triggers. Some of them got defended, some of them we end up managing the position size. And looking back as a whole, that was really the right approach to really stick to a risk management process that we know how to run, that intuitively makes sense to the team and really stick to that discipline. I think the large part of the process is the diversification of areas of interest. And especially with the small mid-cap space, when sometimes the market will give us an incredibly attractive opportunity within one areas of interest. And there is this temptation and tendency to say, well, let's go all in with that. One areas of interest. But at Monroe, we've always said we want a diverse set of growth drivers for the portfolio. So we really stick to that 6 to 7 diverse set of areas of interest and really keep the weight balanced across these areas of interest. And that also turned out to be the right approach just from a portfolio management perspective, to have a portfolio that sort of does fairly well even when some of the areas of interest is going through a volatile time.
So as of now, which is the middle of October, the fund is up, roughly 53%. Have people really missed the opportunity to buy in?
Not at all. We're actually, as excited about a fund today than when we were, 12 months ago. And the reason really is if you look at the underperformance of the small mid-cap companies relative to the larger cap companies, when we launched the fund, and it's roughly true even today, the valuation gap is the biggest in 20 years. So it takes way more than 1 year to really close the gap. And actually, we haven't even seen that gap closing at all. What really drove the performance of the fund is actually the earnings growth of these small and mid-cap companies that we found. And what gives us the conviction, the excitement for the future is we look at our pipeline today. And as much as we're happy for the stocks that we pick, there are so many stocks that we've missed. There are still so many stocks that's really coming our way, even just within our existing areas of interest, that really give us a lot of optimism on the strong earnings growth to continue. And then I'm sure we'll cover that later, but with the interest rate coming down, we do expect the valuation gap to close over a long period of time, and this is not going to be just a 1 year phenomenon.
12 months ago, interest rates were a really hot topic, and they probably didn't come down as much as anticipated. What do you say to that?
We and it's a funny story. So I think first quarter this year, both Nick and myself, we would go on the AFR and we say, well, actually, we don't really care how much the interest rate come down. As long as the interest rates don't go up, we feel really good about how our portfolio is positioned. And that really turned out to be true. For the first quarter of the year, there was a lot of fear on first we have interest rate maybe staying higher for longer. Then investors quickly flip to, well, actually now they're not coming down fast enough because we're going through a hard landing. And then you go through periods of optimism and say, well, this is just the right balance. The Fed is going to land the plane. And now we're back to a lot of other debates. But throughout, we just follow our portfolio stocks that crank out earnings growth. And ultimately, we like to use this as a cheeky answer, but it turned out to be true. Does the level of the interest rate really change on how many NVIDIA chips that enterprise and hyperscalers want to buy? Not really. And we own a lot of stocks that's actually in the NVIDIA supply chain. So very naturally, their earnings growth really doesn't have a whole lot to do with the interest rate. And going forward, I think we have received fairly definitive signal. We can sit here and debate how much and how many cuts, but we know we're going to be in a rate cut cycle, and the cycle lasts for a period of time. And we do think this is a really good setup for growth equities, especially for growth equities in the smaller market cap side.
The PE of the portfolio is roughly 30 times. However, you mentioned the sector is quote unquote cheap, but it appears expensive on this metric. Can you explain the difference?
Yeah, so we really look at cheap in two ways. One is the absolute valuation. So the headline PE is 30, but at the same time, we have roughly 10% of our portfolio in infrastructure. And those companies, because of the high depreciation charges, the accounting treatment just make the income very low. So if you look at it on the EV to EBITDA, which to us is a better metric of valuation, the entire portfolio trades at roughly 16 times EV to EBITDA, and that remain one of the lowest ones of all the growth portfolios that we run here at Monroe. So we think that on the absolute level, this is still quite low. But even more interestingly, we do a lot of these comparisons, is within the structural tailwinds that we are really excited about, such as high performance compute, such as climate and decarbonization, such as security. If you just line up the smaller cap companies to a larger cap companies that's in the same areas of interest, in most of the cases, the smaller companies is actually growing faster and trading at a discount. So that's really what gives us the optimism that the valuation level is still more than reasonable, and we still have quite a lot of road to cover.
A question that you're often asked is, how do you address the quality and discovery issues of global small and mid-cap companies sitting here in Australia?
Yeah, we feel really good about the corporate assets that we have for the small and mid-cap companies. And it's a little bit of a joke, but it's actually true, that a lot of the smaller companies, they're so starved of attention from investors and analyst communities. I don't think their phone ring very much. So when we actually phone in or offer to see them at their company headquarters, I mean, the doors to the C-levels really swing open for us. So we've had actually excellent corporate assets for the small and mid-cap companies. But in a larger scheme, a lot of, actually most of the senior staff and the investment team, we've had extensive years of our investment career outside of Australia in fairly major financial hubs. So I think there was a really good foundation of just network and experiences right there. And lastly, some of the most effective channel checks / corporate assets actually come from our larger companies within the Monroe Global Growth universe that probably give us the most insights on both a potential product roadmap or the management quality of the smaller companies. So I often say, how do you know a small semiconductor company's management team is really good? Well, call up NVIDIA and call up TSMC, and they will tell you if the supplier is any good. The same goes with larger industrial companies. We'll call the larger companies and say, have you heard or partnered with or competed against the smaller companies? And often we get the most valuable insight from the larger companies.
How do the smaller mid-cap stocks leverage or debt profile compared to large cap stocks?
I mean, look, it's a really large variety for the entire market. If you look at the market as a whole, the small cap index definitely has more leverage than the large cap index. But for our portfolio as a whole, the entire portfolio sits on net cash. I mean, this is a pure growth fund. We're looking for earnings growth. We're not really looking for deleveraging stories. We're not really looking for corporate restructuring. We're looking for growth stocks that can have positive earnings, positive free cash flow to support their own growth. So most of these stocks have no leverage at all, and most likely will stick to that profile going forward.
Mid-sector stocks are notoriously volatile and considered high risk compared to large cap stocks. What are your thoughts on this notion?
Yeah, I mean, first of all, it's all about risk-adjusted returns. So with any stock picking, large or small cap, I think the risk and returns is really the two questions the investors have to have a really good answer to. To us, the risk is multifold. Of course, there's risk, and frankly, I've been out there saying this is not a portfolio for everybody. This is a portfolio for a group of like-minded investors that really want to back a high conviction portfolio of stocks that's going to grow really strongly, that currently is trading at a really attractive valuation. That's really the value proposition for the fund. We think about risk really in a couple of ways. One is obviously we have to be right with our thesis. So we have to be right with our earnings. So our own EPS forecast is probably where we spend 80% of our time looking at and making sure that's right. That is the biggest risk, is us being wrong with our own earnings. And then the second one, how to mitigate risk, is to make sure you don't overpay for it. So that's why we didn't fall for a lot of the story stocks that I talk about. We really stick to the valuation methodology that we use at Monroe, that we can really have a proper mathematical underpinning for. And lastly is that diversification. Is to say we're really excited about 6 or 7 really large structurally growing trends that we think is going to last for the next 15 to 20 years. And we don't back one of them, we back 6 or 7 of them. And I think at different times that balance and diversification also mitigate a risk on the portfolio level.
How is the portfolio positioned for the remainder of 2024 and heading into 2025?
So the areas of interest that we really back, these are really long-term in nature. So some of these really, large structural trends such as high-performance computing, such as decarbonization. I mean, we really think we are still in year 2 or 3 of a 20-year trend. So we will continue to position, fairly heavily towards, these 6 or 7, areas of interest that we are really excited about. Some of the newer things that could be coming into the portfolio, which we are doing a lot of work on, is really to follow this idea that AI is broadening its use case and applications to industries that, seemingly have nothing to do with technology, but is under the hood being really transformed by the use of artificial intelligence. So you start to see security as an areas of interest being a larger part of the portfolio. We're doing a lot of work around innovative health. We do think that there were a lot of really interesting growing healthcare companies with better use of data and AI. Those can really be quite transformative. So we're excited about those trends, but broadly speaking, the top 6 or 7 would actually remain pretty stable.